Good evening. Welcome to AS-11. First of all, tell me, are you enjoying this chapter? Did you like the question given to you? One more practice we will do, and then you will become stronger on AS-11 basic entries. So please note down. Question for you. Please note down this question for you. ASF Limited reported, I have to dictate a question because study material does not have too many questions. ASF Limited reported, ASF Limited in bracket reporting currency INR. INR means Indian rupee. Reporting currency has entered into falling transaction. Has entered into falling transaction. Just please note down the question on the screen. Please note down the question on the screen. Please note down the question on the screen. You can see the question on the screen. Please note down. Are you writing? So note down this question. 1/4/2020. Good student will write 1/4/2020 purchased machine on credit. Purchased machine on credit rupees 10 lakh. 1/5/2020. 1/5/2020 purchased goods for $30,000. Purchased goods for $30,000 on credit. Purchase goods for $30,000 on credit. Spot rate equal to rupees 62 per dollar. Come on, fast. Spot rate equal to rupees 62 per dollar. 1/6/2020. 1/6/2020. Paid to creditors for goods. Paid to creditors for goods. $20,000. You have purchased 30,000. You have paid 20,000 proportionately. Some amount will remain on balance sheet date. Spot rate rupees 65 per dollar. Spot rate rupees 65 per dollar. 1/7/2020. 1/7/2020. Purchased car for $40,000. Purchased car for $40,000. Spot rate rupees 67 per dollar. Spot rate rupees 67 per dollar. 1/8/2020. 1/8/2020. Revalued car upward by $5,000. revalued car upward by $5,000. So this adjustment we have done in one earlier problem. Spot rate rupees 68 per dollar. Spot rate rupees 68 per dollar. Spot rate rupees 68 per dollar. Next, 19/20/20. 19/20/20. Sold goods. Sold goods. $10,000. Sold goods for $10,000. Spot rate rupees 69 per dollar. Spot rate rupees 69 per dollar. Spot rate rupees 69 per dollar. Closing rate on 30th September 2020 is rupees 70 per dollar. Is rupees 70 per dollar. Is rupees 70 per dollar. Past journal entries. Past journal entries. Past journal entries. Past journal entries. So like previous question, one more practice which has mini transaction. Now the interesting thing in this problem is the first transaction is in rupees. The first transaction is in rupees. The reporting currency is also Indian rupee. So here no conversion required. Otherwise student will convert rupees into some more rupees. Okay. So that was to trick you. That is already in rupees. So no further conversion required. Of course other transactions will be required to be converted. So please write down journal entries. Journal entries. Date, particulars, debit, credit. Draw one full page format. Narration will be homework. Narration will be homework. Date 1st April 2020. 1st April 2020. Machinery account debit 10 lakh. To vendor account 10 lakh. This is already in Indian rupee. No conversion required. No conversion required. 10 lakh rupees. 10 lakh rupees. Now next entry is on 1/4/2020. 1/4/2020. On this date, you have purchased goods of $30,000. Rate of exchange is 62. So the entry would be purchases account debit. Continuously follow me. 30,000 into 62. 18,60,000 to creditor for good. To creditor for goods. 18,60,000. To creditor for goods 18,60,000. To creditor for goods 18,60,000. Now out of this 30,000, 20,000 were paid. So 10,000 will remain outstanding. So at the time of payment, you will proportionately reverse the creditor, but the payment was made at a different rate, so therefore there would be exchange loss. So write down 1/6/2020. Continuously pay attention. Creditor for goods account. Creditor for goods account. We are paying only $20,000 into 62 into 62. 12 lakh 40,000. 12 lakh 40,000. Exchange difference account debit 60,000. This is balancing figure. To bank account. To bank account 20,000 into 65. To bank account 20,000 into 65. 13 lakh. To bank account 13 lakh. To bank account 13 lakh. So $10,000 is still outstanding. That at the end we are going to revalue. Okay? Any query up to this? Then they have purchased one car also for $40,000. On that date the rate was 67. 1st July 2020. 1st July 2020. Car account debit. Car account debit $40,000 into 67. $40,000 into 67. 26 lakh 80,000. 26 lakh 80,000. To vendor for car account. To vendor for car account 26 lakh 80,000. Now this car was purchased for $40,000. Keep in mind, and it has to be revalued. So when you will do the revaluation, you will apply the rate for the entire amount, not just the increased amount, but revaluation will be done for the whole car. Any query on this? Now come to 1/8/2020. 1/8/2020. Car account debit. Car account debit. Total value of the car today is 40,000 plus 5,000. We are going to apply the exchange rate today on the entire amount minus the book value. Minus the book value. Similar problem we have done. So the final answer is 3,80,000. Sanket is right. To revaluation reserve 3,80,000. So car has already been revalued. Car is not required to be revalued again. 1/9/2020. Come on, fast. Everybody, don't go away. On 1/9/2020, we have sold goods. We have sold goods. Debtors account debit 10,000 into 69. Debtors account debit 10,000 into 69. 6,90,000. To sales account 6,90,000. Come on, everyone. To sales account 6,90,000. Your study material does not have such detailed question. Now what happened? We will come to 30th September. On 30th September we will see which are monetary items and which are denominated in foreign currency. Which are monetary item and which are denominated in foreign currency. So one is creditor for goods. Creditor for goods $30,000 minus $20,000. So $10,000 is still payable. Then debtors $10,000, and there are creditors for car. So that is also foreign currency item. Initially we purchase something from a creditor, the first entry is not a monetary item because that is in home currency. The first creditor is already in rupees. That will not be adjusted. But these are the parties who are required to be adjusted. Even though car is carried at revalued amount, revaluation has already been done and there is no information about revaluation on 30th September. So car will not be further adjusted. So what I'll do, I will see at what rate these were recorded, what is the year ending rate, and the difference will be recorded in exchange difference. So please write a note or please write an entry 30th September 2020. We'll take one by one. We'll take one by one. First we'll take exchange difference account debit. Exchange difference account debit 80,000. Why 80,000? Because when the creditor for goods were recorded, the rate was 62 and now at year ending date, the rate is 70. So the entry will be exchange difference account debit $10,000 payable into 8 rupees 80,000 to creditor for goods, to creditors for goods 80,000, to creditors for goods 80,000. Then there is a vendor for car also. We have to pay him $40,000. When the car was purchased, the rate was 67. Today the rate is 70. So exchange rate has gone up by 3 rupees. So my entry will be exchange difference account debit. Exchange difference account debit 40,000 into 3. Exchange difference account debit 40,000 into 3 to vendor for car, to vendor for car 1,20,000. Narration is homework. To vendor for car 1,20,000. And similarly we have a dater also which is denominated in foreign currency. So in case of dater also, I will see at what rate dater is recorded and what is the year end rate, and the difference will be recorded as exchange difference. So the next entry would be 30th September 2020. 30th September 2020, dater's account debit 10,000. Why 10,000? When dater was recorded, the rate was 69. At year end, the rate is 70. So by 1 rupee, the rate of exchange has gone up. So dater will be increased by 1 rupee into 10,000, 10,000 rupees, and to exchange difference account, 10,000. To exchange difference account 10,000. This is the answer of this question. Write a note. Exchange difference will be transferred to P&L account. Write one homework. Prepare trial balance as on 30th September 2020. Prepare a trial balance as on 30th September 2020. So this is the entry, and similar questions are given in your notes also. In your exams also, similar questions are being asked. So I hope you enjoyed. Now you are on page number 2 of this chapter. We are talking about recognition of exchange difference. Now, just now you have written a note that exchange difference will be transferred to P&L account, but there are some exceptions. There are some exceptions. So I will tell you the reason for this exception. Paragraph 5 in your book you will find there is an amendment in Companies Accounting Standard Rules 2006. What is the exchange rate in India? Exchange rate when India got independence in 1947, it was around 9 or 10 rupees. Then slowly and slowly it kept on increasing. So let's say around year 2005, it became something like 50 rupees. One student is asking a query, why we are not revaluing the car? Car is already revalued once. Okay, so in the previous question, this car has already been revalued. The one who has asked this query, say this entry. So whatever information was given based on that, car is a non-monetary item. Car is a non-monetary item. It will be revalued whatever rate of exchange is given on the date of revaluation. That we have done. They have not given anything about 30th September, that whether on 30th September the car was revalued or not. So we will not revalue the car. Car is a non-monetary item. Non-monetary item carried at revalued amount. Exchange rate will be applied on the date when the asset was revalued. So asset was revalued on 1st September. We have applied that rate. So my job is done. Okay, back to this question. Back to this discussion. You are distracting me. So in year 2005 or 6, the exchange rate is rupees per dollar 15. Okay. See the reason for this amendment. Then after that, the exchange rate had started declining also for some time. And somewhere around 2000, let us say 8, it was 38 or 39 rupees. Oh my God. And then again it started going up. And still it is going up only. Okay. Now see the story. When the exchange rate is going down, you pay less for 1 unit of dollar. So what we will do, suppose when you borrowed money, one company borrowed money, $100 million. When that company borrowed money, the rate was 50. And it has to repay after 2 years or 3 years. If it has to repay after 3 years, it will have to repay $100 million, but by that time the rate is 40 rupees. For example, 4040 is the exchange rate around here this time, 3940. So when you borrowed, you got in Indian rupee 5000 rupees million, but when you are repaying, oh my God, amazing, you are borrowing 5000, but you are repaying 4000 because exchange rate has gone down. So what will you do? You will borrow more and more. You will borrow more and more because you know that exchange rate is going down. So I will enjoy exchange gain. By borrowing money, you are gaining. What more do you want in life? You borrow money also. You gain also. And interest rate is already low in the foreign market. More and more company will borrow. more and more company will borrow money. Is it right? More and more company will borrow money. But then what happened? They borrowed here huge amount of money. Huge sum was borrowed. And then came 2009, exchange rate again started increasing and it became 60 rupees for example. It became 60 rupees for example. Now you see, some company borrowed, let us say, $1,000 million at 40 and they have to repay same $1,000 million at 60. Now such company will have exchange loss equal to $1,000 into difference 60 minus 40. Oh my God, hold your breath. Otherwise, you might have a heart attack. They had suffered an exchange loss of $20,000 million loss just because the exchange rate has increased suddenly. And what is the treatment? The treatment of exchange differences. See the previous question. The previous question says exchange difference will be transferred to P&L account. Accounting standard at that time used to say all exchange difference will be transferred to P&L account. If you transfer a loss of 10,000 million, 15,000 million rupees, this is rupees, to P&L account, what will happen to P&L account? Tell me, if such a huge loss is debited to P&L account, what will happen to P&L account? The P&L account will show either loss or a very low profit. So profit will decline or it can result into loss. Earning per share may decline. Market value of the share may decline. So then what happened? Then industries, entities, they went to institute. In year 2009, all these big industrialist company management, they went to the institute. Sir, please do something. Please protect my P&L account. My profit and loss account is showing loss because of this accounting standard 11. Institute says sorry. 2009 institute's president said sorry. These are accounting standard. We can't change standard every day just to keep you happy. Otherwise, the value of standards will go down. I am not going to change. Okay. So, what this industrialist will do? They will go to government. So, they went to government, central government MCA, Ministry of Corporate Affairs. Okay. Ministry of Corporate Affairs, they told Ministry of Corporate Affairs that see exchange rate is rising. Because of AS-11, we have to recognize loss. Our P&L account is showing a very low profit and in some cases it has become loss. Instead of profit, it has become loss and P&L account. Loss account. So therefore government what it did? Government brought a notification. Government brought a notification which is called Amendment in Companies Accounting Standard Rule 2006. Okay. So what is this notification? I will first read one by one. Very interesting. Pay attention. This notification originally was brought on, I remember that date also, 31st March 2009. That was the day the government brought this notification because it was the last day of the year. It was the last day of the year. So they thought that we have to do something in a hurry. And at night 11 p.m. they had brought this notification so that it can be applied from that year. Anyway, So the notification is applicable is with respect to accounting year commencing on or after 7th December 2006 and ending on or before 31st March 2012. This was the original notification that it will be applicable only for a short period. Government told the businessman that I am not going to give you this benefit forever. This benefit is only for a short period because exchange rates are very volatile. So what was the treatment? The treatment was that if exchange difference, as per this notification, if exchange difference arises on long term, that means this notification is applicable only for long term item, not for short term item, long term foreign currency monetary item. So in short, we will call it long term FCMI. LTFCMI, long term foreign currency monetary item. So if suppose you have taken loan, loan is a long term foreign currency monetary item. If the loan is taken for more than 1 year, if the loan is taken for more than 1 year, it is a long term foreign currency monetary item. And if that loan is used for buying a depreciable asset, is used for buying a depreciable capital asset. Example of depreciable capital asset is property, plant and equipment. Okay. So if this loan is taken for this purpose and if the exchange difference arises, that exchange difference will not be transferred to P&L account but will be adjusted in the cost of this depreciable capital asset. So instead of charging or crediting to P&L account, you will debit or credit the respective property, plant and equipment account which was acquired from the loan taken for that purpose. And if the loan is taken for other purpose, if the loan is taken for other purpose, second line here, if the loan is taken for other purpose, then what you will do? Don't charge it to P&L account immediately. Rather, you will defer it under a heading called Foreign Currency Monetary Item Translation Difference Account, FCMITDA account. You will defer it and recognize it in P&L account and recognize it in profit and loss account up to 31st March 2012. That means you will recognize in installment, not entire amount. So the benefit of this amendment is if the loan is taken to acquire depreciable asset, your P&L account will not be charged in that year, rather asset will be debited and slowly you are going to provide depreciation. So it will get transferred to P&L account but not all of a sudden, but over the life of the asset because it will get capitalized over the asset cost. Or if it is related for other purpose, if the loan is taken for other business purpose, then what you will do, in that case, you are going to first defer it and amortize it over the remaining year, not beyond 31st March 2012. So at least you don't have to charge full amount, you can charge small amount. This was the benefit given by the government to the businessman. But then what happened? 2012 also passed. After 2012 passed, again the businessman came to the government. Again the government extended that date by some more years. So what you do? You write down this chart in your notebook. And on that we will take two questions, one dealing with case 1 and one dealing with case 2. So this is now the position I am sure students are enjoying and writing. Please write down in your notebook uh, amendment in Companies Accounting Standard Rule 2006. Amendment in Companies Accounting Standard Rules 2006. And what was that amendment? That amendment says if the exchange difference, if the exchange difference relates to long-term foreign currency monetary item, if the exchange difference relates to long-term foreign currency monetary item, so if it is a short-term monetary item, this notification is not applicable. And then if that loan or that long-term foreign currency monetary item is related to acquisition of a depreciable capital asset, if you have taken the loan to purchase a depreciable capital asset, example PPE, then what will you do? That exchange difference will be added to or deducted from the cost of the asset, will be added to or deducted from the cost of the asset and depreciated over the balance life of the asset, and depreciated over the balance life of the asset. That was first situation. FCMI relates to depreciable capital asset. But if suppose the loan is taken for general business purpose, loan is taken for any other purpose, accumulate in FCMI TDA. FCMI TDA means foreign currency. In your book it is written monetary item, translation difference account, and amortize over the balance period of such long term loan. And amortize over the balance period of such loan. And amortize over the balance period of such loan. Is it right? Once you have completed writing, please tell me, have you completed the diagram? Based on that, I am going to dictate two questions, and some questions are also there in study material, but those are very easy compared to what I am going to take for you. Okay? So I hope you have noted it, yes or no. So now some important points. Okay. So this company, when this notification was issued, any difference pertaining to accounting period which commenced on or after 7 December 2006, previously recognized in P&L account, may be reversed by adjusting the value of the asset or FCMI TDA as the case may be, and by adjusting the general reserve. Now this paragraph has become outdated now. The reason is it is talking about 2006. Many years have passed now. So basically, when this notification was issued in 2009, it had a retrospective effect. Whatever you have charged earlier will be reversed. Whatever exchange difference you have charged to P&L account on or after 7th December 2006 will be reversed. Okay, but don't pay attention to this paragraph. This paragraph is useless now. It is outdated paragraph because we are now very far away from this date. This is important. This is important. What is this line? Company have a choice. Companies are given a choice. Choice is either you can follow notification or you can follow AS-11. If you follow AS-11, exchange difference will go to P&L account. If you follow notification, then if it is a depreciable capital asset or if it is others, accordingly you will give the treatment. Accordingly you give a treatment. So this notification was not forced on the company. Notification was voluntary. Those who want to adopt this notification can adopt this notification. Those who don't want may not. But once you make a choice, suppose you say to the government that we want to continue to follow AS-11, then it is an irrevocable choice. Irrevocable means later on you can't change your decision. Then every year you have to transfer the exchange difference to P&L account. Or if you make a choice that yes, I will follow notification, then that decision is irrevocable. Irrevocable means it cannot be changed. Just like your course, CA course. Once you enter into this course, it is difficult to change the decision. You will appear after every 6 months, but you are not going to change your decision. Okay. Where will you present FCMI TDA? FCMI TDA will be presented in balance sheet under the head reserve and surplus. So you can just mention whether it is a debit balance or whether it is credit balance. Whether it is a debit balance or whether it is a credit balance. This notification does not apply to non-corporate entities. This notification does not apply to non-corporate entity because it is only for companies, not very important. Only a company form of organization can follow this notification. Okay. Now I am going to tell you some more interesting story. Initially government said this notification is applicable only up to 31st March 2012. After that 31st March 2012 was over, businessmen again went to the government. Again the government extended the deadline to 31st March 2020. Again the businessmen went to the government and now this deadline has been increased for infinite period. Enjoy. Not only that, they have brought amendment in AS-11 only, right? So what they did, they thought that these entities will come to eat my head every year. It is better to change AS only, bring amendment in accounting standard only, and now they have made it a permanent feature. Now it is a permanent feature. And what is that permanent feature? Same thing, don't copy again. The permanent feature is given in para 46A, very popular paragraph. This para 46A gives an option to the entity. Either you do the normal accounting under AS-11 and transfer the exchange difference to P&L account, or you can take the shelter of 46A. What is 46A? Same thing. If it is exchange difference relating to long-term foreign currency monetary item, and if it is related to depreciable asset, you will capitalize it in the cost of that asset and depreciate it over remaining life. And if it is related to any other, you are going to defer it and amortize it over the remaining life of the loan. Over the remaining life of the loan. So if the loan is taken on 1/7/2019 and the loan will be repaid on 31st March 2028, then you are going to defer and amortize it over this period. If the loan is going to be repaid on 31st March 35, then you are going to defer and amortize it over this period. So now entities don't have to go to the central government every year and ask for extension. You have a choice and you can defer it and you can amortize it over the remaining period. Is it right? So now, as I have promised you, I am going to dictate two questions. Very important, because your study material also has similar question, but study material question is very simple. I am going to give you a detailed question. So please write down question. Please write down question, and you can practice today homework. Today's homework. Practice all questions. If you practice all questions, you will be able to solve any question in India's, any question on accounting standard in the exam, and you will get full marks. So trust me, question starts from first line. ASF Limited. ASF Limited on 1st April. ASF Limited on 1st April 2012. ASF Limited on 1st April 2012 borrowed USD 90 million. Borrowed USD 90 million. Borrowed USD 19 million. 9019. 90 million means in bracket 9 crores. 90 million is equal to 9 crore. The funds were used by X Limited. The funds were used by X Limited for purposes. The funds were used by X Limited for F small sentence continues, for purposes other than acquiring, for purposes other than acquiring, for purposes other than acquiring depreciable capital asset, for purposes other than acquiring depreciable capital asset. Underline this one. For purpose other than acquiring depreciable capital asset. So it may be taken for your day-to-day business, but it was not for acquiring any capital asset like PPE. The loan carries an interest rate of 3%. The loan carries an interest rate of 3% on reducing balance, and is repayable on 31st March 2015, and is repayable on 31st March 2015. The interest due on the loan has been paid in full. The interest due on the loan has been paid in full on 31st March each year. On 31st March each year. On 31st March each year. The exchange rate on the date of borrowing was 1 USD equal to 50 rupees. 1 USD equal to rupees 50. The subsequent exchange rates were as follows. The subsequent exchange rates were as follows. Two columns you will draw. Year ended and exchange rate. Year ended and exchange rate. Year ended 31st March 2013. exchange rate. So 31st March 2013 exchange rate was 51. Oh my god, exchange rate has gone up. 31st March 14, 1 USD equal to 49. 31st March 15, 1 USD equal to 48. So what do you observe? Your exchange rate is 50 rupees, then it goes up 51, then it goes down to 49, and again it goes down to 48 rupees here. So first it goes up by 1 rupee, goes down by 2 rupees, and again goes down by 1 rupee. Plus 1, minus 2, minus 1. Okay. Question is past journal entry, assuming that the company follows para 46 of AS-11. Assuming that the company follows para 46 of AS-11, and to save your time, one line is given, entry for interest need not be passed. Entry for interest need not be passed. Entry for interest to save time. Otherwise, in the exam, you will have to pass entry for interest also. Interest rate is 3%. Loan is $90 million. And these are the rate of exchange which you will apply to calculate the interest. Okay. So is everybody ready with the question? What is the amount of loan taken? $90 million. So first year it will go up by 1 rupee. So 90 million means 9 crore into 1. 9 crore rupees loss. Then it will go down by 2 rupees. So 9 into 2, 18 crore gain. Again it goes down by 1 rupee. Again 9 crore rupees gain. Again 9 crore rupees gain. So when you solve the problem, you have a difference of 9 crore exchange loss in year 1, 18 crore exchange gain in year 2, and 9 crore exchange gain in year 3. But you have decided to apply para 46A, so the entire amount will not be transferred to P&L account. The life of the loan is 3 years, so we are going to amortize the exchange difference over 3-year period. Is it right? Say yes. Once you say yes, it is right, we are ready to go ahead. I will go ahead. Are you all ready with the question? Okay. So everybody is ready. First you draw one table for calculation of exchange difference. So student will write calculation of foreign exchange gain or loss. Calculation of foreign exchange gain or loss. First we'll do that calculation. This table will be useful for passing entries also. So every student will take out his notebook, take a scale, pencil, paper, write. Write the format, it has total 6 columns. Year ended. Year ended, then write down opening balance in FCMI TDA. Everybody, come on, opening balance in FCMI TDA. This loan is taken not for buying a depreciable asset. This loan is taken for other purpose. Therefore, we have to create FCMI TDA account. Second column, opening balance in FCMI TDA. Third column is exchange gain or loss. Third column is exchange gain or loss. Fourth column is total. Fourth column is total. Fifth column is exchange. Fifth column is amount to be recognized in P&L account. Fifth column is amount to be recognized in P&L account. And last column is closing balance. Closing balance in FCMITDA. Closing balance in FCMITDA. So once this table is ready, it will become easy to pass the entry and you will understand it better also. So if all of you have drawn the format, tell me. This format is for checking how much amount we are going to recognize, how much amount we are going to recognize in the P&L account. Just wait a minute. Please wait a minute. Okay, we are almost ready. So all of you are going to solve this amazing question now. So first you write down year ended. What will be my first year ending date? My first year ending date will be 31st March 2013. First year ending date will be 31st March 2013. On that day, opening balance is nil. Opening balance is nil. And exchange loss we have calculated rupees in crore, 9 crore. 9 crore. Why 9 crore? 9 crore dollar you have borrowed and the rate has gone up from 50, it has gone to 51. So 9 crore. Rate is 51 now. It was 50 last year. By 1 rupee, it has gone up. So my total will be opening balance is 0. Current year exchange difference 9 crore. So total balance in FCMITDA account will be 9 crore. AS-11 para 46A says this can be written off over the remaining life of the loan including that current year also. Total life of the loan is 3 years. So 9 will be divided by 3. 9 divided by 3, you will have to transfer 3 crore rupees to P&L account. Out of 9, 3 you will transfer to P&L account and 6 you will carry forward. 6 crore you will carry forward to the next year. This 6 crore you will bring it forward in the next year. So next year write down here. Next year write down 31st March 2014. This 6 crore I will bring it here. 6 crore I will bring it here and now I will check what happened. So my exchange rate has gone down by 2 rupees now. So my calculation will be 9 crore into 51 minus 49. Enjoy. You will gain by 18 crore because exchange rate has gone down. So you have to pay less amount now. 18 crore gain. So take the total minus 6 plus 18 is 12. Minus 6 plus 18 is 12. But the number of years remaining are 2. Number of years remaining are 2. So this 12 I will divide by 2 years. So I am going to now write off 6. Out of 12, 6 I will write off. So what is remaining? 6. 6 will be carried forward. 6 will be carried forward. Then come to the last year, 31st March 15. This 6 balance will come here. This year again, your exchange rate has gone down from 49 to 48. Enjoy, dance. Come on, everybody dance. By 1 rupee. So 9 crore rupees gain. Opening balance 6. Current year 9. Total balance 15. But only 1 year. So the entire amount will be written off. Because this is the last year of the loan. The loan will be repaid on this date. So once the loan is repaid, the balance in FCMITDA account will also be written off, and therefore now the balance left is 0. Now the balance left is 0. So this is the table which shows you how the FCMITDA will be recognized in P&L account over the life of the loan. This is the table. We have to pass journal entries. First complete this table. Those who have completed the table will draw one page format of journal entries. Kindly draw one page format for journal entries. If you want to understand this chapter in detail, we have to go through this process. Okay? Do not look at the watch calendar. Look at the concept. Look at the understanding. These questions are not in any study material of the institute. Any. It is from different book. Only if you go in detail, then you can face this exam confidently. So have you drawn journal entry one full page format? So what I'll do, first I will borrow money. I will borrow $90 million. On that day rate is 50. So I will pass an entry on 1st April 2012. I will pass an entry on 1st April 2012. Bank account debit. How much bank account debit? 9 crore dollar into 50 rupees. 9 crore dollar into 50. Rupees in crore. Right hand side rupees in crore. So you will get 450 crore rupees in your bank, and you have to give, it will give rise to a liability, that is borrowing, to borrowing 450, being long-term foreign currency borrowing taken. Sanket Jain has completed the format. Very good. What about others? Why are you not replying? Have you gone into sleep mode? Being long-term foreign currency borrowing taken. So this is the entry you pass when you take a loan in foreign currency, bank account debit to borrowing. Amount of loan taken multiplied by spot rate on that date. Now we'll come to year end, and in our table we have calculated how much exchange difference will arise. So if you look at the table, if you look at this table, 9 crore loss will arise due to exchange rate. So I am right now going to pass entry for this 9 crore, and then I am going to pass entry for writing of 3 crore. Is it right? So next two entries are FCMITDA account debit 9 crore. Because exchange rate has gone up, my loss will be there, and I will increase the liability 9. Calculations have been done. To borrowing, to borrowing, to borrowing. Being long-term foreign currency borrowing, translated, being long-term foreign currency borrowing translated as per para 46A, being long-term foreign currency borrowing translated as per para 46A, as per para 46A, and then out of this 9 crore, 3 crore I will transfer to P&L account on the same day. On the same day. So the entry will be now 31st March 13, 31st March 13, P&L account debit 3, P&L account debit 3, all these figures are in crore, to FCMI TDA account, to FCMI TDA account 3, to FCMI TDA account 3, being exchange loss charged to P&L account, being exchange loss charged to P&L account as per para 46A, exchange loss charged to P&L account as per para 46A. This is year 1. We have to pass entry for interest, but in the last line of the question it says entry for interest need not be passed. Otherwise one more entry will come, interest account debit to bank. You will calculate interest in dollar first, multiply by the year end exchange rate, and that will be the amount. Now we'll come to next year. Next year we had a good luck. Exchange rate has gone down by 2 rupees. So my liability will reduce by 9 crore into 2, 18. Calculation already done. Entry for reduction in liability, borrowing account debit 18 to FCMI TDA account 18. To FCMI TDA account 18. Please keep replying. Any query? This question you will not find in any of the material of the institute. So please do it carefully. Being foreign currency borrowing, being foreign currency borrowing, translated as per para 46A, as per para 46A. Out of that now, 6 we are going to transfer to P&L account. Same date, calculations have been done. FCMI TD account debit, FCMI TD account debit to P&L account, to P&L account. So the answer is 6. Narration is homework. Keep 2 lines blank. Narration is homework. Narration is homework. Narration is homework. Next, write down 31st March 15. Look at your table. This year also there was a gain of 9 crore. You can calculate 9 crore into 1 rupee reduction in exchange rate. 9 crore into 1 rupee reduction in exchange rate. Borrowing account debit to FCMI TDA account. Borrowing account debit to FCMI TD account. 9. Narration homework. Narration homework. 2 lines blank. Narration is homework. And then we will pass one more entry. You can see in your table, third year, The total balance in FCMI TDA is 15. FCMI TDA account debit to penal account. FCMI TDA to penal account 15. Okay, narration homework. Same narration. Same narration. And you have to repay the loan also, don't forget. One more entry for repayment of loan. One more entry for repayment of loan. Borrowing account debit 432. You have borrowed 9 crore dollar. Exchange rate is 48. Kindly multiply 9 into 48. 432 crore you have to repay to bank account. To bank account. To bank account. Being repayment of long term foreign currency borrowing. Being repayment of long term foreign currency borrowing. Being repayment of long term foreign currency borrowing. Is it right? So this completes a question where for the first time in your life probably you have seen the accounting of 46A para 46A of AS-11 where company has taken a long-term loan but not for acquiring depreciable capital asset. They are allowed to defer the exchange difference and amortize it over the life of the loan. This is exactly what companies have to do now. Now I am going to give you another question where the loan is taken to acquire. Guess, loan is taken to acquire dash, gap, fill in the blanks. Loan is taken to acquire what? Loan is taken to acquire dash, fill in the blanks. Everybody. So the answer is loan is taken to acquire depreciable asset. Write down. Question. Everybody should participate in answering. Saurav Chauhan, depreciable asset is right. Same question with a twist. ASF Limited on 1st April 2012, ASF Limited on 1st April 2012, Gogoi is right, Tiwari right, Jain right, depreciable asset. Same question but a small change. ASF Limited on 1st April 2012 borrowed USD 90 million. Borrowed USD 90 million. There is a similar question in institute's material, but this is much better. This is little advanced than that. Once you can solve it, you can solve any similar question on para 46A. ASF Limited on 1st April 2012 borrowed USD 90 million. Everybody should answer. The funds were used for acquisition of depreciable capital asset. The funds were used for acquisition of depreciable capital asset having a useful life of 5 years. Having a useful life of 5 years. Depreciation charged on straight line method. Depreciation charged on straight line method assuming no scrap value. Assuming no scrap value. The loan carries an interest rate of 3%. The loan carries an interest rate of 3%. on reducing balance and is repayable on 31st March 2015 and is repayable on 31st March 2015. The interest due on the loan, has been paid in full, on 31st March of each year. Has paid in full on 31st March of each year. The exchange rate on the date of borrowing, is was the exchange rate on the date of borrowing was 1 USD equal to INR 50. Exchange rate on the date of borrowing was 1 USD equal to INR 50. Subsequent exchange rates were as under. Subsequent exchange rates were as under. Subsequent exchange rates were as under. Year ended 31st March 2013. Year ended 31st March 2013. Exchange rate 1 USD equal to rupees 51. 1 USD equal to rupees 51. 31st March 2014. 31st March 2014. 1 USD equal to rupees 49. Same rate like previous one. And 31st March 15. 31st March 15. 1 USD equal to rupees 48. 1 USD equal to rupees 48. So I have kept the rate same for understanding purpose. Write down below past journal entries assuming that the company follows para 46A of AS-11. Para 46A of AS-11. Entry for interest need not be passed. Entry for interest need not be passed. Entry for interest need not be passed. Very, very important question. Very important question. So this same question, but this time the loan is taken to buy a capital asset. The useful life of the capital asset is 5 years. So what we are going to do, we are going to adjust the exchange difference in the carrying amount of that capital asset, and we are going to depreciate that capital asset over the remaining useful life. The revised amount will be depreciated over the remaining useful life after adjusting for the exchange difference. Okay? So let us see how to apply the theory into practice. So again I will draw a table, but this time the table is slightly different because I need to calculate the carrying amount of the asset and depreciation also. So are you ready? Are you ready? Start. Heading right down. Calculation of foreign exchange gain or loss. Calculation of foreign exchange gain or loss. Calculation of foreign exchange gain or loss, and then you will write right hand side rupees in crore. Right hand side rupees in crore. Year ended. Then opening balance in bracket asset account. This time we will not have FCMITDA. This time we will have asset account. We are going to adjust the difference in asset account, and then you will say addition. Addition or write down deduction. Addition or deduction in asset account. Addition or deduction in asset account. Because of exchange difference, that exchange difference will be either added to or reduced from asset. Next column, exchange gain or loss. Exchange gain or loss. Adjusted value. So after making this adjustment, we will get adjusted value. Assets carrying amount will change because of this exchange difference, which will be either added or deducted. Then I am going to provide a depreciation. To keep it simple, we will round off the depreciation figure. We can round off for keeping the calculation simple. And the last column, closing balance in the asset account. Last column is closing balance in the asset account. This is really a very important question for your exam purpose. Similar questions have been asked in the exam. Similar question is there in your study material, but they are very easy. Once you do it, you can solve any problem. On para 46A. Once you have drawn the format, please tell me, yes, we have done it. Sir, please start. Don't delay. Okay. Are you ready to solve this question? Are you ready to start this question? Okay. So, first year is 31st March 2013. First year ending date is 31st March 2013, and we don't have any opening balance because we have not acquired any asset. We have acquired the asset, so this will come here. 9 crore into 50 rupees. We have used the entire loan to acquire the asset. Pancharia is ready, Tanya ready, Sanket ready, Tiwari is ready. Very good. So continue the good work. 450 is the cost of the asset when you purchased it. Then in the first year we have seen there was an exchange loss of 9 crore. Calculation already done in case 1. 9 crore. So now this 9 crore exchange loss, instead of debiting to P&L account, it will be debited to asset account. So if you debit the asset account, asset value will go up. So 450 will become 459. 450 plus 9, 459, and divide by how many years? Assets life is 5 year. Assets life is 5 year. So 459 divided by 5 year, this is depreciation. Depreciation is based on useful life of the asset, which in the given question is 5 year, and I have rounded off the figure 92. Okay, so the balance in asset account will be, check, 459 minus 92, and that is equal to 367. That is equal to 367. Is the first year right? Any query? Any query in year 1? No query? Year 2, 31st March 14. Now, this column will have figure. Opening balance 367. Any query? Come on, reply. Any query? Now, this year we have an exchange gain. Exchange gain means we will credit the asset account now. Instead of crediting P&L account, we will credit asset account. So if I credit the asset account, asset balance will reduce. Asset balance will reduce. Asset value will reduce. The student is asking how adjusted value has come. 450 plus 9. Sometimes it seems you people are not listening to me carefully. This is 367 minus 18. Okay. Now how many years are remaining? 4 years are remaining. So 349 divided by 4 years, because useful life is 4 years remaining now. So I am getting 87.25, but as I have decided, I will round it off. So 87. Now I will ask how the closing balance has come. That also I will write 349 minus 87. That is how closing balance has come. Yes. Don't worry, you keep asking any query. Now any query in year 2. Any query, Pawar, any query. Jan, any query. Okay. 31st March 15. This 262 opening balance and exchange gain 9. Calculation done. So adjusted value will become 262 minus 9. This 9 will be credited to asset account instead of P&L account. That is what this para 46A says. You don't have to credit P&L account. You can credit asset account and change the depreciation. So now how many years are remaining? 3 years are remaining. So 253 divided by 3. 253 divided by 3. 84.33, round off. 84. So balancing figure will be 253 minus 84. Approximately check 169. Any query? Any query in year 3? Now at the end of year 3, the loan will be repaid. Loan will be repaid in 3 years. Loan will be repaid in 3 years. However, asset will continue to be depreciated for 2 more years. So good news, now we will not have any adjustment because the loan is repaid. On 31st March, loan is repaid. So no more adjustment of exchange difference, only depreciation. So write down 31st March 16. This is my opening balance. No adjustment, no adjustment. Same figure here, same figure. And 169 divided by 2 years remaining. 84.5, round off. Or you can write 84.5. Balance also 84.5. And last year also just repeat. Asset life is 5 year. So we have taken 5 year. Loan life is 3 year. 84-84, 84 will be written off, and after 5 year the balance will become 0. Either you can round off this figure or this figure, don't worry. Understanding is important. First of all, do you have a query on this table? Do you have a query on this? Say yes or no. Everybody will reply. Do you have a query till now? Any type of query? Okay. Seems no query. So what is the question? Pass journal entries. So we are going to pass journal entry every year. For this first year, we'll pass entry for loan taken to purchase the asset. Then we are going to pass entry for exchange difference. every year we are going to pass entry for depreciation, and in the third year we'll pass entry for one loan repayment also. And institute was kind, they said do not pass entry for the interest. Otherwise, every year for 3 years, one interest entry will also be passed. Gupta, no query. Pawar, no query. Tanya, no query. Okay. So write down journal entries. Write down journal entries. One full page, 1.5 page, because 5 years are involved. Oh my God. This question is waiting for being asked in the exam. Waiting list is clear. Journal entry on 1st April 2012. Journal entry on 1st April 2012. We have acquired an asset, we have borrowed money. So entry on 1st April 12 will be PPE account debit, PPE account debit to borrowing account. PPE account debit to borrowing account 450, being fixed asset acquired by borrowing amount in foreign currency. Being fixed asset acquired by borrowing amount in foreign currency. Being fixed asset acquired by borrowing amount in foreign currency. Second entry is for exchange difference. 9 crore exchange difference will arise, but that will be debited to PPE account, not P&L account, not FCMI TDA account. So this exchange difference will be adjusted in PPE. That is what you have written in the table also, first line. PPE account debit to borrowing account. PP account debit to borrowing account. Narration being long-term foreign currency borrowing translated. Being long-term foreign currency borrowing translated as per para 46A. Being long-term foreign currency borrowing translated as per para 46A. Next time I will not dictate the narration. You will write the narration yourself. Okay, please come to depreciation entry. Keep the table in front of you. 9 entry we have done. Now depreciation entry. Depreciation entry is simple. Depreciation account debit 92 to PPE account 92. Depreciation account debit to PPE account 92. Being depreciation on PPE provided. Being depreciation on PPE provided, and we are not required to pass entry for interest. Next entry, P&L account debit to depreciation account. Next entry, P&L account debit to depreciation account 92. Depreciation will be transferred to P&L account. Depreciation will be transferred to P&L account. Being depreciation charged to P&L account. Being depreciation charged to P&L account. Being depreciation charged to P&L account. So that was year 1. Draw one line. Keep one line blank. We are changing the year now. In the second year, the exchange rate has gone down. So my liability will reduce. My asset value will also reduce. And my depreciation charge will also reduce. So next date write down. Now all narration will be homework after this. 31st March 2014, 31st March 2014. Now you see in the second year exchange rate has gone down. So my liability will reduce by 18 crore. Borrowing account debit 18. Borrowing account debit 18. And what this para 46A says, if that borrowing is for acquiring a depreciable capital asset, you will adjust in the depreciable capital asset 18 crore. So the credit I will give to PPE account. To PPE account 18 crore. To PP account 18 crore. Yes, one line blank for writing narration as homework. This asset value will change. The revised value will be depreciated over remaining years. Calculation has been done for you. Entry depreciation account debit to PPE account 87. Calculation has been done in the table. Calculation has been done in the table. 87. Now only concentrate on writing. Narration homework. Narration homework. Next entry. Next entry 31st March 14. P&L account debit to depreciation account. So what you are observing, that foreign exchange difference instead of directly going to P&L account is indirectly going to P&L account through depreciation. Through depreciation. Indirect way of routing the exchange difference to P&L account. P&L account debit to depreciation 87. Take a scale, pencil, pen, draw one line. Second year is over. One line blank. Start third year. Same thing we have to repeat. 31st March 15. The liability is again reduced by 9 crore. So liability will reduce by 9 crore, asset will reduce by 9 crore. Entry, borrowing account debit 9. Borrowing account debit 9 to PPE account 9. Borrowing account debit 9 to PPE account 9. Narration homework. Narration homework. What was the third year depreciation? Can you tell me? What was the third year depreciation? Look into your table and give me the answer quickly. What was the third year depreciation? The third year depreciation was 84. So write depreciation account debit to PPE 84. Narration homework. Depreciation to PPE 84. This is the third year and I have to repay the loan also. Remember, first you transfer to P&L account. Tiwari is right, 84. P&L account debit to depreciation. Come on, Tiwari. P&L account debit to depreciation, 84. Tanya is right. Pawar is right. Being depreciation on P&L account charged to P&L account. Being depreciation on profit and loss account charged to P&L account. Narration homework, I forgot to tell you. Pawar is right. And this is the third year. Don't forget, we have to repay the loan also. 9 into 48 we have to pay. 48 is the rate of exchange. So the entry would be at the end of year 3, 31st March 15, borrowing account debit to bank. Borrowing to bank. 9 crore into 48. 432. 432. Being repayment of borrowing. Being repayment of borrowing. But remember, the asset will have 2 more years. So we need to depreciate the asset for 2 more years. Can you tell me fourth year depreciation? Fourth year depreciation, please answer. The fourth year depreciation was approximately 84 or 85. So you can write 84 or 85. Depreciation account debit to PPE account. Depreciation to PPE 85, 85. Depreciation to PPE account 85, 85. Being depreciation provided. Being depreciation provided, one last, second last write down. P&L account to depreciation 31st March 16. Draw one line. This year is also over. Fourth year is over. P&L account debit to depreciation account 85, 85. Draw one line. Fourth year is over, and just repeat these two entries in the last year. So this will give you a complete picture of how the accounting is done under para 46A. Exactly, this is what companies also do. Last year now. Last year depreciation. Come on. What was last year depreciation? 84. Depreciation account debit to PPE account. Depreciation account debit to PPE account 84. Narration homework. Last entry for this question. Last entry for this question. P&L account debit to depreciation. P&L account debit to depreciation 84. P&L account debit to depreciation 84. Narration homework. Draw line, big line now. This answer is over. This answer is over. Come back to your paragraph number. Come back to your paragraph number 4. Please come to paragraph 4 in your notes. In paragraph 4, there is an exception. Second bullet point. Is it there? Within AS-11 originally, other than para 46A. This is other than para 46A. There is an exception in AS-11 where exchange difference arising on monetary item. This is one exception in AS-11 where exchange difference arising on monetary item that in substance forms part of the enterprise net investment in a non-integral foreign operation. Underline net investment in non-integral foreign operation. Then it will be accumulated in foreign currency translation reserve. If it is related to net investment in NIFO, non-integral foreign operation, then the exchange difference will not be transferred to P&L account, but it will be accumulated in foreign currency translation reserve, FCT, foreign currency translation reserve, until the disposal. Until disposal. Until disposal means once you dispose this net investment, the FCTR will be transferred to P&L account. So in case if you have once again net investment in a non-integral foreign operation, exchange difference will be first transferred to FCTR, and when the non-integral foreign operation is disposed, sold, then the balance in FCTR will be transferred to P&L account. Till that time, you are going to keep it in FCTR only. Okay. So this is para 4 exception. Now we are going to solve some question. This question number, I will tell you, it is there in your book. Question number 6. After about 6 or 7 pages, you will come across question 6. It is an exam question. This question is repeated also sometime in the exam. So please mark it important. IMP, important problem. So are you there? Question number 6 printed in your book with the solution. So you will only concentrate on understanding. Please come to question number 6. A company had imported raw material. Wow. Imported worth US dollar 2,50,000 on 15 January 2005 when the exchange rate was 46 rupees per dollar. So that day the rate was 46 and the invoice is $2,50,000. The company had recorded the transaction at that rate. Very good. So write very good. Company is good. The payment for the import was made on 15 July 2005. So this transaction took place on 15 January 2005, $250,000, and that day the rate was 46. The transaction was settled on 15th April 2005. That day the rate was 49. However, on 31st March, the rate of exchange was 50 rupees per dollar. In between, you have year ending date. On the year ending date, the rate was 50 rupees per dollar. The company passed an entry on 31st March 2009. Now, this is the mistake this company has made. And this question comes in your exam quite often. The company passed an entry on 31st March 2005 adjusting the cost of raw material consumed, adjusting the cost of raw material consumed for the difference between 49 and 46 per dollar. So what this company has done, this company has made two blunders. First of all, they have transferred exchange difference to cost of raw material consumed. I never told you this. This is never done, but the company has adjusted the exchange difference in cost of raw material consumed. And secondly, they have compared 46 versus 49. 46 versus 49. So this is wrong. This is wrong. 31st March 2005, we should compare the rate at which transaction was initially recorded versus the year end rate. So you have to first write that company should not have adjusted exchange difference in raw material consumed. Secondly, the company should compare the initial recognition rate with exchange rate on the balance sheet date, and that should be transferred to P&L account. The difference between 50 and 49 will be transferred to P&L account in financial year 5-6, and the difference between 46 and 50 will be transferred to P&L account in financial year 2004 and 5. Is it right? So that was the answer. Answer is printed in the book. For your understanding, if you want to draw this timeline, you can draw. Choice is yours. Choice is yours. This difference, which will be 2,50,000 into 4 rupees, 10 lakh rupees charged to P&L account in financial year 4-5, and this difference 2,50,000 into 1 rupees 2,50,000 you credit to P&L account because it's a gain. Exchange rate has gone down. You will credit to P&L account in financial year 2005-6. In financial year 2005-6. So this you can note down, those who are interested candidate. Have you noted? Please let me know. Have you written this note which I have given to you for understanding purpose? Remaining answer is printed in the book. Remaining answer is printed in the book. Have you completed? Yes. Now what you do, in this question you add one more thing from my side. Pass correct journal entries. Pass correct journal entries. Pass correct journal entries. So I am going to tell you, suppose they ask you in the exam to pass correct journal entries, then what will you do? Figures in Indian rupee. First, we will pass entry on 15 January 2005. We have purchased goods. So, purchases account debit to creditors. Purchases account debit to creditor. You are going to record $250,000 multiplied by 46. Please reply. Good student will reply. 2,50,000 into 46. So you are going to record 1 crore 15 lakh. Check. Is it 1 crore 15 lakh? To creditor 1 crore 15 lakh. This will be your first entry on the date of purchase. Then on 31st March 2005, your creditor balance has gone up by 4 rupees. So the entry will be exchange loss in bracket P&L account debit 10 lakh. Calculation already done. To creditors 10 lakh. Please write down nicely a likely question in the exam. $250,000 into 50 minus 46. This is second entry on 31st March, and then we will pass entry on third entry 15th April 2005. Write down 15th April 2005. Creditors account debit to bank account. $250,000 I have to pay. On the date of payment, the rate of exchange is 49. So 2,50,000 into 49, my payment would be 1 crore 22 lakh 50,000. My payment will be 1 crore 22 lakh 50,000. and my creditor balance in the books is 1 crore 25 lakh. This is my creditor balance, 1 crore 25 lakh, but I have to pay only 1 crore 22 lakh 50,000. 1 crore 22 lakh 50,000. So remaining amount will be exchange gain in bracket P&L account. You will credit 2 lakh 50,000. You are going to credit 2 lakh 50,000. Just check whether this is right. 2 lakh 50,000 is your exchange gain. So in case if in the question they add that you need to pass journal entry also, then the student can pass following 3 entries. And this will become a 5 to 6 marks question in the exam. All of you have completed? All of you have completed? So now we'll go to next question, which is also printed in the book. Question number 8. And I think a similar question is there in study material also. Company has adopted the following policy. Company has adopted the following policy. In respect of foreign currency transaction, current assets and current liabilities are revalued at year-end rates. This policy is right. Okay. However, if there is a net loss due to exchange difference, the same is charged off to P&L account. But if there is a net gain, the same is ignored in the view of prudent accounting policy of not recognizing unrealized gain due to exchange rate fluctuation. Comment on the appropriateness of the above. So what this company is doing, it is calculating exchange difference on current asset and current liabilities. There are some items on which you have exchange loss. There are some items on which you have exchange gain. So this company is saying where there is exchange loss, that's what this company is saying. We are charging to P&L account, but if there is exchange gain, we are ignoring it. This portion of the treatment is not appropriate. As per AS-11, all exchange difference should be recognized in P&L account. Of course, in bracket subject to para 46A. Subject to para 46A, all exchange difference on monetary items should be recognized in P&L account. But this company is saying no, only loss will be recognized. Gain will not be recognized. So that is a problem. Okay. So what we will do, we will say that company should transfer the entire exchange difference, whether gain or loss, to P&L account. That was a theory question. Next query. Similar question is there in your study material also. This is in our book, question number 9. Very easy problem. Goods purchased on 24th February, $10,000, rate is 46.60. At year end, 47. On 5th June, it is again 47.50. Calculate the gain or loss for financial year 4-5 and 5-6. Yes. So this problem I will solve by passing journal entries. Please write down in the notebook. In the notebook, write down question number, page number. Question number, page number. Journal entries. Journal entries. You add one question from my side. Past journal entries. Past journal entries. Draw the format. Figures in Indian rupee. First date 24th February 2005. Purchases account debit to creditors account. You will give me the amount. You will give me the amount. Purchases account debit to creditor account. Anybody for the amount? Amount is $10,000 and on that date the rate is 46.60. So that comes to how much? What is the answer? 4,66,000. Narration homework. Is right 4,66,000. Then on 31st March 2005, 31st March 2005, there is a increase by 40 paise. 40 paise into 10,000, 4,000 rupees exchange loss will be there. So I will pass an entry, exchange loss account debit 4,000 to creditors account 4,000, and the calculation will be 10,000 into 47 minus 46.60. So you are right, 4,000 rupees loss will be there. This loss we will transfer to P&L account. Rajendra Pawar 4,000 loss is right. Now one more entry on 5th of June 2005. One more entry we will pass is payment entry. Entry for payment. It is given exchange rate, date of payment. This is your date of actual payment. Properly written in your book. Date of actual payment. Creditors account debit. First you write creditors to bank. And you will pay $10,000 into rate is 47.50. So you will pay 4,75,000. You will pay 4,75,000 and creditor balance in your book is 4,70,000. So the difference is exchange loss again. Exchange loss will be transferred to P&L account. 5,000 rupees exchange loss on the debit side. Check the answer now. Being payment made to creditor. If they ask you journal entry for the same question, then these three entries you will pass. Now, how are you finding this chapter? Are you finding it little easy now? Because as far as transaction in foreign currency are concerned, we have completed that first part. First part was lengthy. In the first part, we had to discuss lot of concept and we have taken lot of questions to build up your confidence. Okay, this chapter has three parts. Second part is foreign operation. Third part is forward contract. But those parts are relatively simpler and easy. So that we will continue on Monday. Thank you very much for watching this video. See you. Bye bye. All the best. Please practice all the questions and come. Thank you very much.